What if you can generate income from stock market every week or every month, not by trading, not by predicting the market crash, but simply by selling insurance? Today, I'm going to show you one of the most popular income strategies used by option traders, selling put options. If you don't know yet me, I'm Professor Fang, and in this channel, I break down investing, option trading strategies, and financial thinking to help you to move a step closer to financial freedom. The information in this video is entertainment purpose only. It's not financial advice, and I am not a licensed financial advisor. Please do your own research before making any investment decision. By the end of this video, you will understand, first, what a put option really is. 2. How selling put options can generate income. And most importantly, the risk you need to understand before trying this strategy. So first, what is a put option? A put option is simply a contract between two persons, and it contains 4 key elements. 1. The underlying asset. 2. Strike price. 3. Expiration date. And 4. The rights and obligation on each side. Here is the key idea. When someone buys a put option, they gain the right but not the obligation to sell a stock at a specific price before a certain date. And when someone sells a put option, they are taking on the other side of the contract. They're agreeing that if the buyer wants to sell the underlying asset, the seller must buy it. In exchange of taking that obligation, the seller of the put option gets something called a premium. So the premium is paid immediately to the seller of the put option. And the seller of the put option will get the premium no matter what happened. So it's kind of abstract. Let's do a simple example. Imagine there's a guy called Jack. He owns a good house worth $1 million. And he's kind of like worried that the house market might fall over the next year. So he wants some kind of insurance. As a put seller, I come to Jack, say, hey Jack, how are you doing? I will sell you an option. Within a year, you have the right to sell your house to me at $1 million. But because I'm taking the risk of the house pricing decrease, you pay me $20,000. How is that? Jack says, okay, I paid $20,000 as insurance, which is 2% of the house price, so that within the next year, if the house price decreases, he can still sell the house at $1 million to me. I have the obligation. So Jack agrees. So now the contract contains 4 key elements. The underlying asset is the house. The strike price is $1 million. The expiration date is a year from now. And the rights and obligation is that Jack has the right, but not the obligation to sell me the house at the strike price $1 million. I have the obligation to buy the house within this year at $1 million if Jack chose to sell the house to me. So let's look at the scenarios. Scenario 1, the housing market crashes. The house dropped to $800,000. And Jack exercises his right and sell the house to me at $1 million within that year. I must buy it at $1 million. In this case, I buy this house at $1 million, even though the house was only $800,000. But as a compensation, I did receive the $20,000 as a premium. Scenario 2, the price stays at the same. The house worth $1 million over that year. Jack has no reason to exercise that option because he can sell the house to anyone. The option expires worthless. So I keep the $20,000, which is good to me as a put seller. I get $20,000 for free. Scenario 3, housing market rises. By the end of the year, the house now worth $1.1 million. And Jack absolutely has no reason to exercise the option because now he can sell the house at $1.1 million to anyone else. Why selling the house at $1 million to me? So I keep the $20,000 premium and I do nothing. If you think it's interesting, please subscribe and give me a thumb up. That will be a very good help for me. If you get through this idea, we can change the underlying asset to stock. So in real market, investors typically sell put options on stocks or ETFs. For example, if you take SPY, the ETF that tracks the S&P 500. So pay attention, in stock market, each contract represents 100 shares. So if you sell a put option, you're agreeing that you might need to buy 100 shares of that stock or ETF at that strike price before the expiration date. That means you must have enough cash or margin in your account. For example, if you sell a SPY $600 put, you must be able to buy 100 shares of those at the strike price. That is $600 at the strike price multiplies 100 shares, which is $60,000. So you have to have either cash or margin of $60,000 to do that. Otherwise, you are under a very big risk. That's the obligation you are accepting. So here I will give you an example. So this is a booklet. Actually, I keep track of all the trades I have. I'm consistently selling puts and a covered call. Here is the example that is representative. So here's the thing. On 2026, March 2nd, I sell Rocky Lab put at the strike price of $60 and the expiration date is March 13. I sold 5 put contracts, which means I have the obligations to buy 500 shares of the Rocky Lab stocks, right? I get premium of $831. At that time, the stock price of Rocky Lab is $70. The strike price is $60. Today is actually the expiration date and the Rocky Lab is around $68. So the buyer of the put has no reason to exercise the put, because if he or she exercise and I have the obligation to buy 500 shares of Rocky Lab at $60 and I can immediately sell out at the $68, I make another $8 for each share I have. So any reasonable buyer would not do that. Look at this. This trade I think is very successful. When I sell 5 contracts of the Rocky Lab put at the strike price of $60, I potentially will need to buy 500 shares at $60, which is $30,000. I have that money ready so that eventually, if this is exercised, I'm not worried. I can take it, right? And within 11 days, I made 2.77% of that $30,000, which is good. And then by the end of the day, I see it's good. And the next Monday, I can repeat this. So I can keep generating income. Sounds very good, right? I can keep doing this, keep getting money, but there's some risk I want you to pay attention to. The biggest risk is very simple. The stock price could fall significantly. If the price falls far below the strike price, you will still be obligated to buy the stock at the strike price. So for example, in my Rocky Lab trading, right? If the stock price significantly fall within that 11 days to $40 from $70, then today I'm forced to buy 500 shares of Rocky Lab at $60, even though each share now worth $40. That's why experienced traders usually follow one simple rule. You only sell puts on companies you are comfortable owning long term. So I understand Rocky Lab's logic. I'm a long-term investor of Rocky Lab. I'm planning to add on Rocky Lab anyway. At $60, I'm very happy to buy more, so I sell put at $60. According to my analysis, Rocky Lab is very cheap at $60 in this year, right? So I will buy it anyway, so I keep selling put. If I get it, I'm happy. If I don't not get it, I'm kind of like happy I get a premium. So here's my mental picture of selling puts. I want to buy something I definitely want, and I sell put on that. So imagine that you're a kid, we're all kids, right? You want to buy a bicycle worth $1,000. And then you went to the shop, you tell the shopkeeper saying, can I buy this bicycle at $800? The shopkeeper would say, no, definitely no, get out of here. But in the stock market, the case is that I want to buy this bicycle at $800, even though the price now is $1,000, people even willing to pay me premiums for me to have the obligation to buy that bicycle at $800, which is very good for me. The key thing is that you have to understand the value of the bicycle. You want to buy it anyway at $800. You're very happy buying it. Okay, hopefully this analogy makes you understand what I'm saying. And there's another technique that traders can use. If the option becomes profitable before expiration, you can buy it back. For example, if you sell put at, for example, $100 premium, right? You get $100 premium, and then the premium price keep going down to like $10. You can pay $10 premium to buy the put back, then you get $90, and you don't need to worry about the rest of the obligation. So you release some fund to back up your puts, and then you can keep selling new puts. Many traders call this rolling the position. Selling put is a very powerful strategy. Hopefully you enjoy it. I'll see you next week.